Good evening, everyone. Just a quick sound check just to make sure everyone can hear me okay. Welcome to the webinar, guys. Just checking out all our attendees that are in here. Welcome to all our beginners into the trading world, or potentially into the trading world. It's great to have you along this evening. Just getting everything all set up here. Make sure the sound is working. Guys, if you do have any questions, if you can use the question and answer panel. Thanks, Michael. Audio's working. Thanks, Mary. Audio's on. That is really good to know. I'll also bring up my chat panel as well, so I can see that. Always people using the chat every so often. I'll bring that over here. Drop that over there. We are in business. All right. Just looking in the background, I can see that the chart is trying to make a move up. So we should get some action hopefully in the back end of this webinar when we get into the charts. But let's start the webinar, shall we? First of all, welcome. My name is Cameron Buchanan, and I am the co-founder of IDTA along with Lachlan Ellsworth. And I'm also a trading coach and the director of IDTA as well. Now, today we're going to got a lot of information to cover. There's a quick bio on myself and a bit of background about who I am, but I'm not going to go into too much detail about that tonight because we've only got 45 minutes and I really want to go through as much detail as possible. So let's get started. So there's a bit of bio on myself. Also, what tonight we're going to cover, we're going to quickly run through who IDTA are, what we do. I talk a little bit about the academy. Also, we're going to be talking about futures foundations. What are futures markets, to give you an idea of what we trade, because there are lots of different markets out there. So I need to quickly explain what that is. Going to go through the popular markets we trade. Also going to talk about the different forms of products to trade. So the different types of markets that are out there. Why trade futures over other products. Also the different forms of trading. So there's different styles of trading depending on your on the way you go about your trading. There's different types, and we're a day trader, so I'll define the difference between day trading and other forms of trading. Also how you access the markets. Also how to open a chart, because I'm going to show you quickly what a chart looks like and just give you some really basic information on what we do as traders. We basically read charts. So I'm going to show you how to read a chart. Also, we're going to show you how you can make money or lose money and how that happens, and also how to place a trade. So lots of stuff to do. Now, I do have to quickly run through our compliance slides because we are authorized by the by Beyond Capital Asset Management to be able to do what we do here. So I do have to quickly run through these slides now. So, so there's our authorizations there. If you want to see our financial services guide, it is on the website, idta.com.au. I didn't mean to click on that. Hopefully it's not sending me. No, it's good. Okay, so just quickly, if you read that, guys, it just explains. I've just clicked on the FSG, which I didn't want to, but that's all right. That quickly explains basically what we do as futures traders. We use margin, okay? And margin basically just means we are borrowing money from the clearinghouse or the broker. We use clearinghouses. So we're borrowing money from the clearinghouse to be able to trade position sizes or contracts, which are a lot larger than what we have in our account. And I'll explain that in a little bit more detail as well. So we are using leverage. So you just have to be mindful. If we ever use leverage, it does carry a higher level of risk. Also, there's two primary risks in trading. You have the risk of gaining money when you take a trade. These are called winning trades. And you also have the risk of losing money. These are called losing trades. And also tonight's program is general information only. And also any performance we go through is obviously is a past performance nature, which means like other financial products, really when assessing past performance, this product, like other financial products, is subject to market forces and unpredictable events that may adversely affect future performance. Now, who are the International Day Trading Academy? Now, we are a group or a community of traders. We're in over 21 countries around the world. We provide education systems. We provide the coaches, the mentors, and also we also have our traders that trade for us in the live trading room. So our professional traders that call trades. We also own proprietary trading systems and indicators that go into the charts and actually give us trade signals. So I'll explain, I won't go into detail about those algorithms tonight. Lockie in the later webinar tonight, part 2, if you're staying behind for that, we'll show you some of the algorithms and talk a little bit more detail about the indicators. So I see indicators as just helping us as traders to spot trade opportunities. So like any financial forecasting system, you need an indicator or a group of indicators to tell you when to act or not. So that's what an indicator is for anyone who's not sure of what that means. It just basically gives us signs or a roadmap in the market. Also, we have 3 live trading room sessions, and these are moderated by our professional traders. And also we have a community of trading hubs that meet together on a monthly basis, and they're scattered all around the world. Now, we are based on the Gold Coast. This is our head office, our training center. I'm currently operating from home at the moment due to this wonderful thing that we're dealing with right now. So we're having a great time at home, working from home and teaching and trading as well. So it's, but anyway, normally we are in our office there, which is based on the Gold Coast. Now let's get into the meat of tonight. Now tonight is all about 10 simple steps of how you can get started day trading. So first of all, I'm going to talk about what are the markets we trade. Now I'll go through the evolution and I'll run through how the futures markets have evolved over time to where they are right now, where we trade from our computer at home on this wonderful thing called the Globex platform, which I'm going to show you tonight, what the Globex platform looks like or how I can access the Globex platform. I'm going to talk about the evolution. I'm going to talk about where the trading started. So the 1700s is where the Japanese rice market started, and that's where then it formed. Then the markets moved in America. Chicago Board of Trade was established, and then the Chicago Mercantile Exchange is where we trade from now, which is the largest futures exchange in the world, and it's accessible to so many people around the world. So that's basically it. So what happened back in the 1700s in Japan was, this is basically what the futures history is all about. What happened was that merchants of rice or rice producers, basically trading rice tickets allowed landlords and merchants to lock in prices at which rice was going to be bought and sold in order to reduce risk. So it was a place where rice producers could go and sell their rice at a certain price at a future point in time. So for instance, they would lock in prices for say 3 months or 6 month periods of time. And these were called contracts, and these tickets were called contracts basically. So the tickets were provided flexibility. So if you were holding a ticket but did not want to take delivery of that rice, you could sell the ticket on the market at a later point in time or any time. And the rules that govern the trading on the Dojima rice market in the 1700s are quite similar to the ones that we use today in the modern futures contracts. So it was basically a point of exchange where traders would meet and producers would meet, and they would exchange these tickets to lock in prices. Now then, what happened in the United States, particularly in the early 1800s in Chicago was going through massive expansion, particularly in the mid 1800s, huge amount of infrastructure. So you had the canal from Illinois to Michigan, which opened up obviously boating trade and railway systems, and then obviously the telegraph as well was also in terms of communication was opened up. So this allowed an area, they needed a place to facilitate trade of particularly agricultural products like meat and grains like wheat, soybeans, corn, pork bellies, those types of products which were sold. So that that was sort of where it all started. And then, you know, in 1885, they created the Chicago Board of Exchange. And now in 1919, they created the Chicago Mercantile Exchange. And this is the largest exchange in Monroe Street in Chicago. If you've ever been to Chicago, you may have been to this building. But for the first 7 decades, trading mainly revolved around agricultural products, but then developed into the, they started to trade products like all types of products, and I'll go through those different types of products. But in the early, sort of in the 1997 was the first share index, and this is what we primarily trade. Now, this is the CME back a few years ago, and this is what was called floor trading. So it doesn't exist a lot anymore. There's not a lot of markets which are floor traded anymore, but floor trading was one of the ways where trading was facilitated from between people and brokers, and all types of people would be represented in this exchange. Now we all trade through what's called the Globex platform, which is an electronic platform, which has really taken over the floor trading. Now we can trade over 70 markets. So sectors like stock or share indexes, you've got currencies, you've got agricultural products like corn, interest rate products, you've got energy like oil, and then also commodities like gold. So there's lots of different types of products that you can trade. Now, in recent decades, you know, the most popular markets now are traded as share indexes. And you may have heard of a share index called the S&P 500. Now, the S&P 500, we trade, one of the contracts or the markets we trade is the E-mini S&P futures contract. Now, basically, this has a leverage value, right? So one contract that we trade is basically works out to be 50 times the price of the contract, or the index that we're trading, or the current market price. So it has this leverage value about it, all right? So keep that in mind. When you look at the price on the chart, the actual price of the contracts we're trading are 50 times that in this one particular market I'm going to show tonight, which is the E-mini S&P 500. So share indexes basically are a great commodity, or a great product to trade, or a great asset class to trade. The S&P 500 is great because it's made up of the 500 largest companies traded on the New York Stock Exchange. Now, companies like Amazon, Google, MasterCard, American Express, 3M, Apple, Citigroup, FedEx, Caterpillar, Coca-Cola, on and on and on. All those products that are listed there are basically joined into one large basket of shares, and this is called a share index, and it's very popular market for all types of traders to trade. So you've got big companies trade these markets as well. So corporations will trade this S&P 500, insurance companies. It's a very popular market to trade. Now, to give you an idea of how popular it is, you've got 1.5 million to 3 million contracts are traded on a daily basis. Now, that value, that leverage value of all those contracts, when you multiply that by 50, all right, will give you an idea of how much money is traded. So anywhere from 225 million to 450 billion dollars, guys, 225 billion to 450 billion dollars traded in one trading day on this particular market. Only one market, all right, up to 450 billion. Now, I don't know about you, but I'd love to make 450 billion a day, but I only want to take maybe $100, $200 out of the market a day. That is great. If I'm doing that, balancing a full-time job or everything I'm doing, that is great for me. All right. So just if I can pluck 50 to 100 out of the market today, I'm happy. All right. You can make more. All right. It really comes down to what your financial goals are. All right. But I've just got pretty little goals, but I like just building and building and building my trading account up, just taking what I call little fish. All right. Just take a little bit out of the market each day, just scoop a little bit out, put into my trading account, and just keep building the trading account up. And if by building my account up, I can start increasing leverage in other ways, which I'll explain a little bit later on. So guys, I don't know about you, but would you be happy if you could make an extra, say, $100 a day? Would that be something that would interest you? out of a pool of a potential 225 to $450 billion, if you could scoop that little bit of extra money out of the market, would that be exciting for you? Well, this is what you're dealing with, guys. And this is why we trade these futures markets. They are the largest markets in the world. And they're accessible from anywhere in the world, as long as you've got an internet connection and a trading platform. Now, what we trade guys, are these things. They're called futures contracts. Now, there's a quick definition for you. I'm not going to go into the detail of it, but if you want to go into a little bit more detail, there's a website down there called investopedia.com. And investopedia.com is a great glossary of terms on any financial word you're not sure of. Go into investopedia.com. They've got a wonderful financial dictionary. So basically, what a futures contract is a legally binding contractual agreement generally made on the trading floor or on a futures exchange, or we do it through the Globex Futures Exchange, to buy or sell a particular commodity or a financial instrument, such as the S&P 500, at a predetermined price in the future. Now, future contracts detail the quality and quantity of the underlying asset. So the underlying asset I'm talking about is those 500 largest companies on the New York Stock Exchange, that basket of shares called the S&P 500. Now, they are standardized to facilitate trading on one exchange, right? You're trading through one exchange, not all these different exchanges. You can't keep a track of price. You're just trading up onto one exchange. Now, some contracts may call for physical delivery, like oil, for instance. You may have heard of what happened recently at the oil market. Anyway, that was a situation. There was a lot of physical delivery of oil. However, other markets are settled via cash. Now, we don't get to the point of settlement because we're not holding these contracts for a very long time. We're in and out, all right? We're day traders. So our trades go for anywhere from seconds up to minutes or to maybe half hour or so maximum, all right? So we're what we call intraday traders, and I'll explain that. So we don't settle anything for cash. We just trade in and out, and we just keep the difference. A little bit more of a definition is contracts obligating the buyer to purchase an asset, such as a physical commodity or a share index that we trade at a predetermined future date and price. All right. Futures can be used in a number of ways. However, we use them to speculate on price movement up or down. That's all we do. We try to work out who's in command of the market, and we trade that up or down. All right, depending on who we think's more powerful, the buyers or the sellers. Now, these contracts are traded by participants through the regulated futures exchange, and that's what we trade through the S&P 500 or any of our markets through the CME on the Globex platform. Now, the futures markets are characterized by the ability to use very high leverage relative to stock markets. So, like I said, if you look at the price, when I show you the price of the S&P 500, I'll multiply that by 50, and that's the price of the contract we're actually trading, all right? That's the leverage value. Now, there's different types of products we can trade, like there's bonds, shares, penny shares, options, cryptocurrencies, Forex. Now, we love futures traders. Now, the reason why is if you look at this table, it's got probably the most important aspects of a good market to trade. You want tradability, right? Which means the ability to get in and out of the market, and there's lots of people trading those markets. So you want tradability. You want liquidity. Look, liquidity is volume. You want the volume of contracts or assets to exchange, right? Now, we've got a huge amount of contracts that we can trade. So, we're down here. We're the E-mini futures. So we can trade. We've got high tradability. We've got high liquidity. We've got great volatility at the moment, especially. We've got lots of competition, which means there's lots of people trading into these markets from all around the world. So there's lots of traders out there, more and more people entering the markets more and more every day. Price transparency is super important. The reason being is we want to see what the price, the real price is of what you're trading. You don't want some price which is made up by a broker or somebody else. So in terms of evaluation, why these markets are the best to trade, the E-mini futures, it ticks all of these boxes. Therefore, it's highly recommended to trade. Whereas if you look at other different types of asset classes like stocks, penny stocks, Forex, options, there's lots of reds, right? So, you want to stay away from the red flags. You want to be where the green is, all right? Because these are all the checklist boxes that you need. And this is why we trade the E-mini futures. So high liquidity, high volatility, great competition. Now there's different forms of trading, right? There's scalping, which is where we're basically taking small profits repeatedly. A lot of our traders are scalpers. We just take lots of trades that last anywhere from seconds to minutes. So scalping is a trading strategy that attempts to make profits on small price changes. So you're looking for very small price fluctuations. And you can take anywhere from 10 to 50, 100 trades a day if you want as a scalper. Now, also there's day trading. Now, day trading is about buying and selling on the same day. So you're in and out. All right, that's what we do. We're in and out on the same day. And you can take anywhere from 1 to 2, maybe 10 trades, depending on how many times you trade. But you're really just focusing on small, once again, small movements in the price of the market we're trading. Because we find it's easier to get the small fluctuations than to try and catch the large types of moves. Now there's momentum traders. Now momentum traders can be in the markets for days, maybe weeks, and they're trying to take advantage of what we call breakouts. There's also swing traders. Swing traders, once again, can be in the markets for anywhere from 1 to 7 days. But once again, they're trying to time and trying to catch the movement as the market's swinging and trying to catch onto running price trends. Then there's also position traders. And these are people that are in the markets for weeks up to months. So larger term traders, more like stock type buy, hold and pray people. So people who are buying stocks, holding onto them, hoping that they'll eventually go up. So they're more your position type traders. Now, let's get into the futures markets. Now, how do you access the futures markets? Now, basically what you need, first of all, you need a demo or a live futures trading account. And then when we get our account set up, we actually have to connect the data feed from our charts to the exchange. Now, this is where you're getting real-time data into the market. So I'll give you an example and I'll show you what's happening right now. All right. Okay, this here, if you can see that, this is the real-time price action right now. This is data that's coming in from the exchange onto my computer. So anyone that's a blue, all right, that's basically a seller, all right? That's somebody who's sold in the market. And then the green ones, or these yellow ones, are buy orders. So people have aggressively buying the market. And then over here, I'll show you, this is another thing. This is called a depth of market. And this is telling us what the current price is in the market. So you can see that's the current price. And you can see here that that was the last price that was exchanged. And you can see how it relates to what we call the time and sales or the tape. All right, this is the tape. This is all the transactions. So you can see when this price, when the price which is highlighted yellow, that is the current price. And you notice there's no large spread between the buyers and the sellers. All right, so these are the sellers over here, and these are the buyers. All right, so when you see the markets. At the moment, the market's sort of staying around this price. So there's not a lot of movement right now. The market's just, going back and forward, from just little price fluctuations. But these are the smallest little movements in price, all right? These are what we call ticks. And the market's basically just moves from tick to tick, all right, from price level. You can see we're edging up a little bit higher in the price. We're moving up from 88 back to 87.75, back down to 50. So we're just sort of fluctuating, in a sort of a sideways sort of movement in the last minute that we've been watching that. But what I wanted to show you that was these are the prices, all right, that's actually occurring. And these are the contracts which are being traded. So you can see it's just a game between buyers and sellers. And basically we just want to see who's going to win. All right. And this is where we start to use the charts. Also too, we can place orders on our charts and these will transmit exactly through to the exchange. All right. So our order goes through what we call the futures commission merchant and goes up onto the exchange. So the FCM or the clearinghouse allows us to be able to place trades on the market. So they're the guys that are allowing us or facilitating the trade through that one exchange. being the Chicago Mercantile Exchange. So all this data is coming off the exchange. Now you can see here that we've got a bit of a lift in the price at the moment. The market has moved up slightly while we've been here. It's probably moved up about 1 point since we've been looking at that. All right, so that's what we're doing here as traders. And guys, if you've got any questions, please send them through while we're going through this. So let's go into a chart. Now, there's a couple of things you need to understand about a chart, right? A chart has a few components to it. It has a time scale, and it has a price scale, and it has what we call candlesticks. Now, I'm going to show you the current price. I'm just going to bring this up right now, and I'm going to build this chart in front of you. Now, this chart is a very basic chart, but what it has is basically candlesticks. Now, these red and green things with wicks and tails and what we call bodies, these are called candlesticks, and these candlesticks are a representation of price movement over time. Now, as we can see at the moment, this is the current candlestick which is forming, and I'll zoom into it so that you can see it. And you can see here it relates to the current price, which is just over here. You can see the time and sales there. You can see that relates to the current price. So as it moves up to 88.25, you can see the market's moving up as well. So this is just a candlestick which is currently forming at the moment. So this is what we basically are looking for. We're actually waiting for patterns in the chart. So I'm going to show you what we're looking for ideally. I'm just going to go here because the most important pattern that we look for as traders are what we call an ABC pattern. An ABC pattern is probably one of the easiest things to spot as a trader. So I'm going to show you what an ABC pattern looks like when I bring up this chart again. I'm just going to go to show you an ABC pattern. Bear with me, guys. All right, so if I was trading, this is what I'm looking for, right? This is one of the basic patterns. So this was the chart I was showing you, right? Now, what I'm looking for as a trader is we've got the price here, right? So that's the price, and then this is the time. So you can see how that's the time down here, and these are all the down here is another what we call volume. All right, that's all the number of contracts which are currently traded in the market. So I'll bring that up over here. Okay, so I'm just showing this. I'm just projecting this onto another chart, guys. So just apologize if I'm not looking at you at the moment. I just want you to focus on the chart. Now, when you look at this, what we're looking for are patterns that are occurring. Now, when I look at this, I can see a couple of different things. I can see that the market is moving in a upwards, what we call a trend. All right, we're moving into this type of pattern that's occurring. Now, also too, what's happening is see these two waves that are occurring. These waves are starting to come together and starting to cross. Now, when we start to see this type of wave cross, this is another indicator that can help you with an idea that the market's potentially moving in a trend. But what we can see is that the market is moving up. You can see we're starting to, when the market goes up and it comes back, it's sort of going in this upwards direction. And this is what we're looking for. We're looking for the market to create trends. Now, one of the most simplistic patterns that we look for is what we call an ABC pattern. And with the ABC pattern, this gives us an idea that the market is going to be going in this direction. So basically, as traders, all we're looking to see is who's winning. Are the buyers winning? So the green team, are they winning? Or are the sellers winning? Now, just by looking at this, you don't really need to know that much about trading to know that, hang on, the market's trending up. We're potentially getting a cross in those indicators or those waves, and we're getting ABC patterns occurring. We could be going up. So I'm going to back the buyers and I'm going to buy the buying team. So all I had to do in that situation, if I was wanting to buy the market, all I'd have to do is go over here and I can place an order on the chart down here. So I can just go, I'm going to put a buy order down here on that particular price. And then when the market comes through, that's going to put me into the market. Now, if I want to make money, how do I make money, right? If I buy here, I want to sell up here. I don't want to sell down here unless I really have to, because if I sell down here, if I sell down under that level there, all right, I'm going to lose money, right? I want to be able to sell up here where I can make money. Now, what I need the market to do is from here is I need the market to go up. All right. Now, when you start trading is we basically use these things called, I'll just bring this back over. I want to go through this. All right. How you make money. First of all, we need to back the strongest team. The strongest team, the buyers or the sellers. Now, I'm backing the buyers because they're the guys I think are going to be strongest. Now, the leverage value of the futures contract is really going to help, because even though the market's only going to be moving maybe 1 or 2 points, that is still worth a lot of money. If the market moves 1 point, that's worth $50. If the market moves 2 points, it's worth $100. Right? So this is where we need to work out the size of your profit box. So if I bring over this chart again, and I'm going to say this profit box right here, right? This market, all it has to move is 1 point from 3044 to 3045. If it gets to that price, all right, before it goes back down here to where my risk is going to be. Oh, there it goes. If it came back here to where my risk would have been, right there, right, I would have lost potentially $100, $150, all right? But if the market moves there first, I would have made $100. Now, if it moves up to 2 points, which is up to 3046, I've just made $100. And as we can see, the market did go through and made $100 plus. It went through. But if I got filled on that order, if I bought there, I would have sold there, and that would have been worth $100. Even though this says it's only moved $1, $2 to there, remember that you've got to multiply it by 50. All right. And that's where the leverage value comes into play. And that particular trade would have been worth $100 or $50 if my target was there or my target was there. All right. So that's how you make money in the futures markets. Now that's step 9. So you need a pattern, you need a signal set, and you need to basically know what you're doing, right? But you need to be able to, be able to put a trade on by using these buttons as well. All right. So the next thing I want to show you. Oh, great question. I'll get to that question, Kirk. So let's just go through a little bit more detail. All right. So basically in this situation here, let's say the movement, this is gold, right? So gold moves a little bit differently, but if gold, or their price scale is a bit different, but if gold moves $1, all right, let's say I bought down here at 6 o'clock and my target was up here I bought it at 1100 at 6 o'clock and I wanted to sell at 1101, which was one point, right? Or $1. Now that, if I buy there and sell there, all right, it's called going long, but I get to keep that difference, all right? And that money goes into my trading account. And that difference is actually $100. All right. So that's how it works out. Every market will have a slightly different arrangement in terms of its leverage, right? But gold and the S&P 500 are very similar in terms of the way their price scales are. All right, that's basically an example of how that works and how you make or lose money. So you want your target to be filled before your risk gets filled. All right, but that's why we get in and out very quickly, because we're getting in on those short fluctuations when we start to see everything aligned, all our indicators aligned, and we get in and out very, very quickly. So, Kirk, what do the candlesticks represent? Or what do the wicks. Okay, I'll quickly show you. Now, I'll just cancel that order there. So what do the wicks represent? Okay, so this is on a buying candle like this. I'll get this out of the way, On a buying candle, what it tells me is that there was the opening price. All right. I'll just grab my annotations so you can see. Okay. So that there is what I call that price there, right down there. Sorry. Oh, I can't move it. Anyway, let me try that again. Sorry, guys. I haven't used the drawing tool much lately. I might just clear that. Whoop. Should not have touched that, should I? Stay there, camera. Let me try and do that again. I'm just going to basically do this instead. So that there, right? That there is what we call the opening price. That's the open price right there. Now, that up here, that represents the high. So the market opened here, looks like it created the high point, and then after 5 minutes, that's what we call the close, right? That point there, the C. So there's an open, a high, and a close. Now the low was also on that candle was also the opening point as well. All right. So that's basically how you describe a candle. So you've got that little wick up there is basically the difference between the closing point and the high point. Now, if you look at like a red candle, so a selling candle, like for instance, this one here, if I just mark that one there, that basically did the opposite, right? It opened here, all right? So that was the opening level. So we opened here. It made a high point there. Then it moved down, made a low point there. And then it made a close right there. So they're the four components of the market, of a candlestick. The open, the high, low, and the close. All right. So if they're green, they close higher than they're open. If they're red, they close lower than they're open. So red candles are basically an attempt by the sellers to come into the market and dominate. But if we see patterns like this, what it's showing us is that we're getting a lot of green, then red, then green, a little bit of red, but the green are doing a better job. All right. So that means buyers are in command, the buyers in control. You want to be trading with the buyers. All right. So let's go to where we are currently right now. Now, at the moment, you can see the market, there's really no patterns. The market is basically stabilizing between these points here. So there's not a lot of action in the market right now. So there was on the European Open, there was an ABC pattern there that went all right with the trend. But now you can see here that the market, see how this indicator here is changing colors and it's starting to lose and they're all starting to join together. That just means the market is in what we call a range. So there's no trend. We're kind of stuck between these areas. And, you know, the only way to trade a range is basically sell the high, buy the low, and just trade between that. All right. It's not a trend trading strategy. We prefer you guys, when you as learners, is to look to trade with the trend and trade with the green MDI. So here's a nice little kind of pattern forming here. There was your first ABC pattern that looked like it would have gone about 100, 150, yeah, about $100 on that particular trade. That one there looks like it would have gone maybe $100, $200, $300, $400. So you can see how the patterns with the trend are very, very powerful technique. All right. So that's a little bit on the charts. Now, how do you place a trade? Okay, I'll come back to the chart in a minute. How do you place a trade? Now, on the right-hand side of the chart, you have these buttons here. So you've got the buy market buttons, sell market buttons, etc. All right. If you want to buy the market, if you've got a pattern setting up and you want to get into that price and you think the market's going to go up, basically we call this one-touch trading. All you simply have to do is click the buy market button and that'll put you into the market. If you want to sell the market, you just click the sell button over here and that will put you in as a seller. All right. So, and that's the great thing about day trading, the futures markets, is that we can buy or sell at any point in time. It doesn't matter. If we think the market's going up, we buy and join the buyers. If we think the market's going down, we sell and join the sellers, and then just buy back at a later point in time. So let me show you how it's done, right? So let's say, for instance, here, right? Now I'm just going to give you an example, but let's say I think the market's going to go down. I'm going to sell the market. See this button over here? I'm going to sell. Now that's immediately put me into the market. Now you can see my orders are in the market. I've got my this is what we call my stop loss, which is red. All right. So I'll keep my stop loss out of the market, and I've got my buy down here. I'm just going to put my buy down there. So I'm just basically just trading between the range. So if the market goes down here first, I've made basically, because these boxes, that there's a $150 box, right? If I just wanted to make $100, that's basically a $100 box. That's where my target order would be. So if I sell something, I need to buy it back, all right? And that's the profit I get to make. Now, as the market is, let's see how this market goes. You can see here the actual dollar value that's basically occurring. Now, I'm in simulation right now, which means I'm not live. I'm just giving an example of what happens when you put an order into the market. Now, this order goes up onto the exchange. If I was in a live trade, this would be on the live market with all the other traders. So you can see here, it's minus 1250. All right, that's what my current position is. But I need to let the market breathe. All right. So now I'm down negative 25 on the trade. All right. So this is why an important thing about trading is that you just don't place trades willy-nilly, right? You have a strategy, because the market really could go anywhere from here down to here at the moment, because we're in a range. We want to start to see the market creating some patterns, and we want a nice clear trend in the market. All right. So this is not a trade I would take, guys. So don't be spooked out by the numbers, but just a really good example of why you don't take trades going in, with following a strategy, or following a trend, or following a pattern, or something which makes sense. So if I wanted to say I made a mistake, so I don't want to take this trade anymore, I want to close out, and then I can just bring this down here. I'm just going to stick it right behind there. And if the market goes up there, it's going to close me out, and I'm going to lose if I got in at 88 and I got out at 89.25, well, let's just make it a round number. All right. That'd be a $50 loss on the trade. But if it goes to here first, then I've made $50 on the trade. All right. So hopefully that gives you a good example of how you put trades into the market. So guys, I will just get rid of that, because now we need to move on to the next subject. Now, so guys, what we went through tonight, I just wanted to show you the 10 simple steps of getting started in trading. So first of all, you need the right markets to trade. And this is why we trade the futures markets. you need to trade the most popular markets. Now, we trade the S&P 500 or what we call the share indexes. They're the most popular markets to trade. There's also different products you can trade. So we talked about shares, Forex, all those different types of options, all those other types of things, and how futures ticked all those boxes for tradability, liquidity, volatility, and competition. And that's what we want to trade. And this is why we trade futures, because we want to be able to take advantage of these fair and regulated markets. And we want to take advantage of these small fluctuations in price. And this is why we are day traders. We get in and out of the market. We're scalpers. We don't stay in the market for a long time. We want to take advantage of these small moves in the market and take the profit and get out. We don't hold overnight positions. Now, how to access the markets. I showed you how you go straight up through your charts onto a regulated exchange, being the Globex exchange, which trades 24 hours a day virtually. Also, I showed you how to open a chart, how to read a chart, all the different components of the chart. You had the price, you had the time, and you had the candlesticks. And you had those 4 components of the candlesticks. Then I showed you how to read a chart. Basically, if you have some patterns in the chart and you have what we call stair stepping and you have a trend indicator showing you what the trends are, that's how you read the chart. You want to be trading with the trend. Trend is your friend. How do you make money or lose money in the markets? All right. The market, all you have to do is put your order in, you buy there, you sell there, or you sell there. Whichever goes first, you make the money. If it goes to your target, if your market goes back and goes down and you sell at that lower price, where you lose that amount of money. All right. All right. So it's a game of wins and losses. And then I showed you how to place a trade just by simply pressing on those buttons. Buy or sell is all you have to do to put a trade into the market. So guys, that's the completion of the introduction to day trading part 1. If you've got any questions, guys, please send them through and we will go through it. We had a great question. How do you make money on a short? Okay, basically just keep the difference. All right, so for instance here, you can see here, the market, if it goes down here, see I'm in profit because I sold here and I'm buying it back at a lower point at a lower price. So if I sell it at 388 and I buy it back at 387, I get to keep that amount of money, right? That's my profit. That's my profit box. See, I'm out of the trade. I've just made from there to there. I've just made. Just going to show you here. I've just made that. So my entry was there and my target was there and I just made $50, sim dollars, right? That's not real money, but it moved 1 point. So that's what you can do. This is the great thing about trading, guys. You can buy and sell at any point in time. So when the market's crashing and falling apart, you can sell the market and get out. All right. So that's a great question, Mark. Great question. So guys, thanks. Please, if you've got any questions, please send them through and we'll get through to them, or stay on because Lockie's going to go through part 2. So if you found this interesting and you want to find out more about day trading the futures market, Lockie is going to go through the webinar. Now, this is the link. If you want to access the webinar, I'm going to put the link into the chat. I'm going to put it into the chat so you can all see it. Lockie's going to go into a lot more detail about the markets. All right. So you can register that. That's going to be occurring in about 10 minutes time. So you can go off, go to the toilet, grab a bite to eat, grab a drink, come back at 7 o'clock and tune in for Lockie Ellsworth. Now, Locke's going to run through part 2, right? That's Lockie there. He's going to run through. He is the founder of IDTA and the systems architect and our head trader as well. Now, Lockie's going to go through day trading strategies, techniques, and performance. So you're going to understand market design, in more detail why you should be trading futures. He's going to go through the foundations of a great trading signal. I've gone through a couple of basics just now. He's also going to go through our proprietary trading signal, being the delta. He's going to go through 6 rules of day trading that you can follow. If you're out there and you are already trading you can just follow these 6 trading rules and just go and run with it. Also, he's going to go into the live charts, show you some live chart analysis, probably from tonight or the next best session. And he's obviously going to show you the strategy and test the strategy's performance. So you get to see some of our IDTA strategies in action, and you get an opportunity to rate how good they are. So guys, thanks for spending some time with me tonight. I'll look forward to you joining the IDTA community eventually. If you are interested, if you can't make the next webinar with Lockie, and if you want to find out more about day trading with us, if you would like to book in a tour of our members area to show you our site, we're going to go through, show you the modules, show you our trading community, show you what you receive as being a part of the IDTA community. If you want that tour of that of the members area, all you need to do is to type in yes. All right, type in yes, and we will take you through the next steps of becoming a trader. All right, so just type in yes, and we'll make sure that you get a call, and one of our membership managers will run through and show you what it's like to be a member, show you the modules, what our trading education is all about, and go through a little bit more detail about those personal questions that you may have that we don't have time to go through tonight. So guys, thanks for joining. Stick around. We'll see you in the next webinar. Hopefully, if you can't make it, once again, just type in yes, and we'll make sure that we'll get in contact with you over the next few days. Thanks for joining, and bye for now, guys.